IRS Code 7702 decides if your policy is legally life insurance. IRS Code 7702A decides if it's punished like income. Those two rules, not performance, decide whether your IUL survives. You followed the rules, you funded it responsibly, you trusted the illustration. That virtue carries a liability. Compliance without margin is fragility. You didn't buy speculation, you bought permanence. But 7702 doesn't freeze that issue, and 7702A doesn't forgive later success. A policy can pass today and fail 10 years from now, usually after income changes, after distributions begin, and after the first loan is taken. The IRS never warns you. They simply reclassify. The moment that happens, tax-free becomes taxable and reversible becomes permanent. When the mistake finally shows up, it's during the year you need access the most, and flexibility is already gone. So if your policy is compliant, but not resilient, what do you think it actually protects? Hello, my name is Robert Balkach. I'm the founder and CEO of Black Swan Insurance Group. Since 2017, my team has helped over 20,000 families and business owners redesign how their capital behaves under pressure. We've earned more than 850 five-star Google reviews, not because we sell products, but because we prevent structural mistakes before they surface. This conversation isn't about tax code trivia. It's about understanding the guardrails that determine whether an IUL strategy actually stays tax-free over decades, not just at issue. So if you already have a policy or you're considering one, the smartest move isn't optimism. It's verification. Quiet clarity beats confident assumptions every time. So if you want a second set of eyes on whether your structure truly respects these rules under stress, click on the link below and you can book a conversation with me and my team. No pressure, just perspective. Because once these rules are violated, what breaks next cannot be undone. Let me introduce you to Dr. Andrew, 46 years old, orthopedic partner, peak earning years, high income, but uneven, surgical volume, partnership distributions, buy-ins, and the ever-present reality that one injury or one policy change can alter everything. Dr. Andrew did what disciplined professionals do. He saved aggressively, he invested consistently, and he funded an index universal life policy as a tax advantage buffer outside of his practice and brokerage account. The policy was approved, the illustration looked conservative, the funding plan fits his cash flow. At the time, everything was clean. What no one modeled was the future version of Dr. Andrew. The year he scales back surgeries, the year distributions flat, the year capital gets cold at the practice. Dr. Andrew believed the hardest part was getting started. Once the policy was in force, he assumed tax-free status was permanent, and that assumption almost cost him the strategy, because 7702 and 7702A don't care who you were when the policy was issued. They only care how the policy behaves as your life changes. And Dr. Andrew didn't know it yet, but there was already a clock running. Point number one, 7702, the definition trap. Here's the first guardrail most high earners misunderstand. IRS Code 7702 defines whether a policy qualifies as life insurance in the eyes of the IRS. Not philosophically, not emotionally, mathematically. If a policy fails 7702, it stops being treated as life insurance. When that happens, the tax advantages you thought were locked in simply disappear. This has nothing to do with returns. It has everything to do with balanced premium relative to debt benefit. Andrew's policy was designed aggressively for early cash value. That worked while income was strong, but when funding slowed during a practice transition, internal ratios shifted. The guardrail didn't move, but the policy did. And this is the first silent danger. A policy that passes 7702 today can fail it later if it wasn't designed to tolerate change. The IRS doesn't notify you. They just reclassify it. At that point, Dr. Andrew's policy was still compliant, but this was the last phase where correction was simple. He just didn't know it yet. Point number two, 7702A, the MAC line you can't uncross. Section 7702A is where strategies permanently break. This is called the Modified Endowment Contract Rule, also known as MAC. This is the line that determines whether distributions are treated as life insurance or taxed like ordinary income. Most people don't violate 7702A by being reckless. They violate it by being successful early or inconsistent later. Overfunding, catch-up contributions, funding charges after income drops, all common and all dangerous. Dr. Andrew came close during a year where he tried to make up misfunding after a slower surgical schedule. On paper, he looked responsible. In reality, he pushed the policy toward a 7-pay limit. At that point, Dr. Andrew thought the danger has passed. The policy wasn't a mech. The funding was corrected. Everything looked fine again. That relief didn't last, because avoiding a mech once doesn't mean the policy is safe forever. This was the last year where enthusiasm could still be restrained. And what came next had nothing to do with the tax code. The interruption didn't come from health. It didn't come from the markets. Dr. Andrew got divorced. Not dramatic, not hostile, just precise, expensive, and legally exposed. One afternoon, Dr. Andrew sat in a conference room while asset statements were slid across a polished table. Accounts, balances, values, all listed, all visible. And this is where most financial strategies collapse. Qualified plans gets divided. Brokerage accounts trigger taxes. Liquidity suddenly matters more than performance. So Dr. Andrew's concern wasn't lifestyle, it was control. He needed access to capital without triggering taxable income, without court permission, and without dismantling assets meant for his kids. Policy loans matter here in a way illustrations never show. They were not reported as income, they didn't violate 7702A, and they didn't force liquidation during emotional stress. The IRS didn't change the rules, Dr. Andrew's life did. And the structure either held or it didn't. Point number 3, design versus illustration. Here's the uncomfortable truth. Most policies are sold to pass. They're not designed to endure. They pass underwriting, they pass compliance, they pass illustration reviews. But they were never built to survive income compressions, policy loans, or long-term retirement distribution. 7702 and 7702A don't punish bad intentions. They punish fragile design. Dr. Andrew's policy worked because it was built with margin, death benefit flexibility, conservative funding relative to limits, and ongoing monitoring as his income evolved. That margin is what keeps a policy alive during disruption. The moment you need tax-free access the most is the moment these rules are least forgiving. Here's the final verdict using Dr. Andrew's real illustration. For 7 years, he funded $8,000 a month, a total of $672,000 during his peak earning window. That decision was anchored to one clear goal: retire at 60 and start taking income at 61. No stacking, no added complexity, just redirecting capital already under pressure elsewhere. By age 65, the policy projected approximately $797,000 in accumulated cash value. By age 60, right as he steps away from the operating room, there is roughly $1.1 million. By age 65, approximately $1.48 million. That timing matters because starting at 61, the structure was designed to support approximately $95,000 per year in projected tax-advantaged income, aligned precisely with the moment earned income stops. Not early, not delayed, not dependent on markets behavior. Without triggering taxable income, without selling assets after market drop, without asking permission from an employer, a court, or a market. But the most important number wasn't the outcome. It was certainty. A 7-figure death benefit projected well into his retirement, designed to protect his kids during the years they still need guidance, not just inheritance. College flexibility, legacy clarity, options that remain intact even after he steps back. This is the belief most high earners miss. Tax-free wealth is not created at funding. It's maintained through restraint. 7702 and 7702A don't reward enthusiasm. They reward discipline across decades. So if you already have a policy and you haven't mapped it to the exact year you plan to stop working and start taking income, you're guessing. If you're considering an IUL policy and no one has shown you how it behaves in retirement, not just at issue, you're exposed before you start. So you can always click on the link below and book a call with me and my team, not to buy anything, not for a pitch, just to find out whether your structure actually supports the year you plan to stop working, and the decades that follow. Because once these rules are violated, there's no appeal process, no reset, no second chance. And remember, it's not what you earn, it's what you keep. Enjoy the ride.